Sometimes you don't know what you don't know. And I find that in the home buying process, and especially in the loan process. So today we're going to tell you a little bit about how to go through the loan process. Well, Sandy, can you start with telling everyone what a pre-approval is, and how a pre-approval is different from a pre-qualification, and what is it that you want when you're buying a home?
Absolutely. So the main difference between a pre-qualification and a pre-approval is that the lender will require you to submit your income documentation and pull credit when doing a full pre-approval. They want to be able to examine and make sure they're accurately determining what income can be used to qualify you to purchase a home.
So what makes a pre-approval better? Isn't a pre-qual just good enough?
Not in today's market. There are, so many buyers out there and not as many properties for people to buy. So you want to make sure that you have a secure pre-approval. There's nothing worse than, finding the home of your dreams and then finding out after you've put down a deposit that you don't actually qualify for that home.
What are the different things that are available? And big question, when does mortgage insurance come into play?
That is a great question. How do we determine that? Well, FHAs, I'm going to go into FHA first because it's not actually for first-time home buyers. Anyone can use an FHA loan as long as they meet the guidelines. So one of the big differences between a conventional and FHA loan is your credit score. Right now, FHA will allow you to go down to a 600. And you can have higher debt to income ratios. Conventional is more conservative. They're looking for a minimum of a 620, but you're going to see your better pricing and better eligibility once you're above that 640 to 660 range. It really takes a look at the full credit profile, and that's one of the reasons why we use an automated system to help us review and evaluate the whole profile, not just that the income fits to get you qualified. We have to take a look at many other factors. How are you utilizing your credit? Have you had derogatory credit? Maybe you don't have a lot of credit. So there are many things that come into play when we're looking.
So can you tell us, in an FHA loan, for example, what you would have to put down and what the associated costs are that are specific to an FHA loan?
Yes, absolutely. So FHA requires a minimum of 3.5% down payment. They also have an upfront funding fee. So after you put your 3.5% down, FHA then adds on top of that base loan amount a 1.75% upfront funding fee to give you your total loan amount. On top of that, they also have monthly mortgage insurance. So if you're only putting your minimum of 3.5% down, your monthly mortgage premium will be 0.85%, and that's every month for the life of the loan.
So that never goes away. The mortgage insurance component never goes away. If I
Correct.
get an FHA loan, I put 3.5% down. On top of that, there will be a funding fee and a mortgage insurance premium that lasts the life of the loan.
Correct, unless you were to refi down the road into a conventional loan.
Okay.
If you put 5% down on an FHA, upfront funding fee is the same. Your monthly, though, is for only 0.8%, and that stays on the loan for 11 years. So after 11 years, you could have the MI removed, as long as you have 20% equity in the home.
Okay. So at the point in time if you've put 5% down,
Yes.
that once you have 20% equity in the home and been paying on that loan for 11 years, you can ask that the mortgage insurance be removed. Do I have
Correct.
that right? Okay.
That
good.
is correct.
Okay. So that tells us a little bit about FHA loans. What about conventional loans? And do conventional loans have mortgage insurance?
Yes. So conventional loans, there's actually quite a few different programs under conventional. But when you put 20% down, you do not have private mortgage insurance. There's no monthly mortgage insurance once you're putting 20% down.
Okay.
Anything less than that will require monthly mortgage insurance. And the coverage that you have depends on the amount of money that you put down. And then the fee associated with that is dependent upon your credit score. So it can vary on every single person that is looking to do conventional less than 20% down. Now, one of the things with conventional is that once you have 20% equity in the home, you can ask the lender to do a review of value. And if that value is 78% or less, they can just remove the MI. You don't have to refinance.
You need to make that request.
Correct.
Okay.
Yes.
It
as the
doesn't
homeowner,
automatically.
It does not automatically. They will just keep collecting it from you until you actually reach out and ask them to do a review.
Okay. Okay.
Now, anything less than that, if you're not putting 20% down, so conventional will actually start as low as 3% down. If you're a first-time buyer, if you meet income restrictions, there is a home ready and home possible loan with 3% down, but you're at 80% of the median income for your county. If you fall into that parameter, then you can put as little as 3% down. The typical, yeah, go ahead.
So what you're saying is that every loan is very individual to the family or person applying for the loan, and that there are no real blanket qualifications. It's individual to every person.
It is very individual to every person, and that's why I always tell consumers that I know your neighbor may have gotten one program or may have gotten a rate or may have, gotten so much in closing costs. Every single consumer's situation is different, and it is always best to speak to the lender and have the lender review, again, your income, your credit. The assets you're going to use also play a part in the purchase. Do you have your own assets saved? Will you be getting gift funds? All of those have to be reviewed, and then the lender should look at all the options that are there for you depending on what your scenario is. So yes, every consumer situation is different, and it's a hard thing to understand when they're hearing that, their neighbor, their friend got this rate or that. I don't know what played into that situation.
So as an individual is ready to apply for a loan, what kind of documentation are you going to need to be able to qualify them for a loan?
So the minimal documentation that we need are your W-2 from the last 2 years and your most recent pay stub, as long as you have 30 days worth of income reported and gross earnings are on it. Those are really the two key pieces to reviewing your documentation to get a good idea as to what income we can use. Now, if you are self-employed, you're going to have to provide 2 years of tax returns to the lender.
Okay, so to get started, that's pretty much everything you're going to need to do that pre-approval.
Yes, and then we can have a conversation about where the assets are going to come from. Have you been saving them? Are you using a retirement account? Or are you going to get a gift? Because that documentation is different for each piece of what you would need.
Okay. Now here's a question I get all the time and I hear a lot is, why has my lender asked me to provide the same piece of documentation 3 times?
We hear that all the time. And unfortunately, what that typically means is that what you provided may not have satisfied something that we were looking for. So if you provide a bank statement, we didn't get all pages, we're going to come back and ask you for your full bank statement. Did you know that you have to even provide the blank pages? So a full bank statement, because the lender looks at pages 1 through 7. We want to see all 7 pages.
Okay.
It could be that when we got the bank statement, there's a deposit in there that we need some more information on because it's not a payroll related deposit. So it may feel like we're asking you for the same information, and 9 times out of 10, what we're looking for is additional documentation based on what we've reviewed of what you've sent to us.
Okay. Are there any things that you look at right before closing? I think what I'm looking for here is, what can a consumer do that's going to, could possibly hurt them being able to get the loan at the last minute?
Great question. We look at credit to make sure you haven't opened up anything new. Okay. So just because you're cleared to close and approved doesn't mean you should go out and open up a Home Depot or Lowe's card to go get your appliances. You really need to wait and do any large purchases until after you have keys in your hand and you know the loan's been funded.
In other words, don't buy a new car.
Definitely not.
Don't buy new furniture for that wonderful new house that you're purchasing.
Unless you're paying cash and that cash isn't needed for the transaction, okay, you can do whatever you want. But anything that's going to open up new credit or increase the credit you already have is going to be a detriment to your loan approval. And it can stop you from purchasing your home. The other thing I would tell you that we look at, we have to make sure documents don't expire. So, and again, your bank statements, what's most important to them is we're always looking for deposits that are non-payroll related. So we don't want to see a chunk of money going in. So we want to make sure that your assets stay the way they were when we approved you.
Let's talk a little bit about credit scores. Can you explain what a credit score is, where that number comes from, and I guess most importantly, how important is it in the loan transaction?
Credit scores are actually incredibly important in the transaction. Why are credit scores or credit so important? Because we're looking to see how you manage your debt. How do you manage your paying of your bills? Do you pay them on time? How do you utilize your credit? Are you overutilized? What does that mean? That means, am I maxed out? If I have a credit line of $1,000, have I used up the whole $1,000? So your credit score and credit is made up of several different factors. They look at installment loans and they look at revolving credit. So on the revolving credit, they don't want to see that you have used more than 30% of what is available to you. So again, $1,000 limit, you don't want to have more than $300 on that particular card at any given time. Okay. The other big part of that is the history of your credit. So a lot of people will get a 0% credit card sent to them. They're like, oh, I'm going to pay everything off and put it on there. And then they go and they close that credit, those old credit cards. Well, now you've actually hurt your credit because you're starting new credit now, and anything that you've had for a long time where you showed a history of paying on time, you've now closed. So there's no way of measuring that anymore. So just transferring to a 0% isn't always the best to help your credit score. So we look at utilization of credit. That's really what the credit process does to make sure, can you really manage your bills? Are you paying them on time, and are you utilizing them properly? And now they actually show on the credit report what the required payment is and what your actual payment is.
So what's a good credit score? What's a bad credit score? What kind of credit score do I need to buy a home?
Sure. So your government loans for Security National, we will go down to a 600 credit score.
Okay.
Those are just for government loans. Conventional, it's a minimum of a 620.
Okay.
If you want the best interest rate,
Okay.
your credit scores need to be, so on a government loan, your better rates are going to come 660, 680 and above. Okay.
Is there a difference in interest rate between a 680 and a 780?
Yes. Yes.
Okay.
More so on conventional than on government. So conventional is definitely looking for a higher credit score for a lower interest rate.
Okay.
Yeah. Mm-hmm.
So it is very important, if you're planning to get a mortgage in the future, that you manage your credit properly and that you strive to have the highest credit score you can.
And the other thing that we do is we like to ask the consumer, do you have a home you've seen on from your realtor or on MLS that interests you? Let us run the payment so you can truly see what that payment would be on that property, because sometimes we think that the payment is less, sometimes we think it's more. So we can give you a more accurate idea based on a property that you've identified that you like. Maybe you haven't gone to see it, but hey, if I went to see this, could I afford it?
And, and that's what we've always said. And one of the reasons we work so well together is that, I can often say, let's run that by Sandy, or let's get Sandy involved here so she can see this is a little bit more than we had talked about. So let's get Sandy to run the numbers. So Sandy, with every transaction, there are costs in addition to the sales price, their closing costs. What are the lender closing costs?
So for Security National, we have a processing fee and an underwriting fee. Those are our two origination costs.
Okay. So go ahead.
I'm sorry. So the only other thing that a lender would charge for is if you chose a specific interest rate and you chose to buy down that interest rate. You wanted something less than what the par market rate was. And that's, again, a consumer's choice. We review it to make sure it makes sense. And that would be the only other fee that we actually have on for closing costs.
Okay, so just to circle back on that, basically you can pay a fee to buy down the interest rate to get an overall lower interest rate over time, correct? And that's a one-time fee.
Correct.
Okay.
Correct. And now as myself as the lender, I always show the consumer what the benefit is to doing that, if there is a benefit. Or I share with them that, based on where the market is the day they're looking to lock, that buying down the rate really doesn't make sense.
Okay. So in addition to those closing costs, there are other fees, which are by the title company for actual handling the paperwork, the lien search, the title search, the title insurance policy, which protects the consumer against claims on title, the title of the property. And then there are some other fees and escrows that are required typically by the lender of, say, a certain amount escrowed for your taxes for each year and an escrow for your homeowner's insurance. And as a rule of thumb, when you add all those together, do you agree that it's somewhere between 3.5% and 4% of the purchase price of the house?
On a resale home, yes.
Yes,
I would
on a
agree
resale home. Right.
Yes.
Right.
Yes.
Okay.
The other thing to take into consideration is capital contributions for homeowners association dues.
Right.
Are
And
also in
that's
there. But yes,
kind of on a case-by-case basis, depending on the
is.
individual community. Sandy, people tell me all the time, they don't want their credit pulled because they're concerned about it affecting their credit score. Well, obviously you need to have your credit pulled in order to get a loan. So talk to us about that.
Sure. Yeah. So it is really important that the lender pull your credit. Okay. Because we can be given a credit score, but typically when you're purchasing a home, the mortgage company of choice that you choose to work with, when that credit is pulled, the credit simulator or statistical analysis done behind the scenes is different than when you're purchasing a car or you're opening up a credit card. So it's a lot stricter. And it again goes back to what we talked about earlier about credit utilization and kind of how you've got yourself paying off your debt and things on time. So with that being said, people want to shop for a mortgage. So the typical rule of thumb is if you have 2-3 people all for mortgages pull your credit within a 30-day period, they should all get the same score. Once you go past that 30-day period, let's say you wait 45 or 60 days and then you have a mortgage person pull your credit, if things have changed on your credit reporting, your score is going to go down because those are hard impacts to your score. We are definitely pulling a full tri-merge when we're looking at your credit report to purchase a home.
So if I just go to one lender and have my credit pulled for the purpose of a mortgage, is my credit score going to go down temporarily?
It should not.
Okay.
The lower your credit score is, though, the more impact it is on your overall credit. Yes.
Okay.
So I think one of the other things that people and consumers need to realize is that when you're purchasing a home and taking out a mortgage, it does not have to be a painful process. The lender that you choose, if you were to choose myself with Security National Mortgage, we try to ask you for all your information up front. We ask you all the questions that we feel will be needed, and we try to streamline the process by getting those documentations up front and always letting you know through the process where you are, whether you're in processing, underwriting, or closing. But a full transaction these days, if everybody works together, 30 days max, and we're seeing a lot of people getting through the process in 21.